renovation loan types, okay? So remember, we can use the renovation loan for purchases, which we would take the purchase price plus the renovation equals the acquisition cost. Just like in that example that we gave, you're going to buy for $500,000, you're going to go out with Sean, get a $100,000 contract, add those together, your acquisition cost is going to be $600,000. Okay? From there, you will put down your down payment. If it is a refinance, kind of like what we're going to talk about for your transaction with the $200,000 bill, you would take the existing loan balance plus the renovation cost, and that would become your new loan balance. So, the first renovation loan type that we're going to talk about is the FHA 203K. And that is, FHA, remember, stands for Federal Housing Administration. And the reason why we talk about that one first is because the FHA 203K is considered the grandfather of all of the renovation loans. They came out with it first, okay? They actually came out with it in 1990. But the reason why they're really picking up speed right now, they were very popular for a while during the mortgage meltdown the first time around. The main reason is because prior to that, we had subprime loans, and we had much more expanded criteria. But once the feds and the private sector started to put more heat and more significance on the livability, the health and safety issues, renovation loans came forward again. And here we are in this climate as well, right? Where we've got a lot of property on the market that, in fact, I was looking online yesterday, there was a ton of properties with boards on the windows, fires that had occurred in the house that the seller just didn't fix anything. And so anyway, the FHA 203K. Now, the FHA 203K allows for 110% of the after improved value. It is the only loan program that allows it. So what does that mean? When we have a renovation, there is more than just the renovation component, meaning the cost of the renovation, that goes into that transaction. There are the closing costs, the renovation consultant, all of these different layers of inspections. So because of that, what the FHA 203K allows us to do, so let's keep with our example, we've got a $600,000 acquisition cost. We send out Ron, he performs the comparable search and comparable approach appraisal for the home buyer, and that appraisal comes in at $600,000. Now, what that means for us as a lender is if the renovation cost exceeds that $100,000 for some reason, they are, not the renovation cost, but the closing costs force that renovation cost higher, then we have access to an extra 10% in that appraisal value. So in that case, I get to take that appraisal, $600,000, multiply it by 110%, so now it is $660,000. And that allows us to include closing costs and other costs in there for the buyer in order to get them over that hump. The reason why the FHA 203K allows that is because FHA loans by origination were built as first-time home buyer loans. They're not required to be a first-time home buyer now, but it was originally built for the first-time home buyer. The FHA 203 has a series, right? So the loan program that you are used to hearing about as an FHA loan is an FHA 203B, like boy. For FHA disaster loans, FHA 203H, like hurricane. And then for the FHA 203K or the renovation component, FHA 203K, like kitten, okay? So 3.5% down payment is all that you need to put down on your $600,000 loan acquisition cost. Owner occupied only. Standard allows, in fact, any FHA loan right now will allow you to go up to $747,500 as a loan amount. And then if you are, whether you're doing the limited or the standard, you need 6 months to complete the renovation. So all of your renovations need to be completed within the 6 months. Now, one of the most amazing things about this 110% after improved value is we can use the minor version of the FHA 203K in order to solve for low appraisal value. Okay? We have used this to solve and save so many escrows from falling out because the home did not appraise at the sales price or the acquisition value. And that is happening right now, right? As sellers are trying to get as much as they can, and folks are overbidding for those quality properties, then what ends up happening is you may contract a property at $600,000, but the value comes in at $580,000. But who's got the extra $20,000 to bring in or more, right? Depending upon what your overbid situation puts you in. So in those instances, what we can do is we can switch your loan from a traditional transaction to an FHA 203K limited. You can go out, and I'll make the advice that you can go out and you can get a construction contract for solar, right? Go see your solar company, get solar, get a $20,000, $35,000 package for solar. We'll pop that on, and guess what? Now, because it's a renovation loan, your appraisal value is not $600,000 anymore. At the 110% calculation, it's a $660,000. So now we just solved for any shortage that you had in your appraisal value, and the buyer no longer needs to bring in an additional $20,000, and over that he gets solar, right? How awesome is that? And now he's not going to have an electricity bill either, depending upon what he picks. So very amazing, and the FHA 203K is the only one that allows for that calculation. The home style renovation is the... Yes.
I'm sorry. Quick question.
Sure.
So FHA is a renovation loan.
Correct.
Okay, what was the FHA-B? I didn't get
The
that.
regular old FHA loan that you're usually talking about.
Okay.
No
H,
renovation component.
H is a disaster.
Yep, disaster for hurricane. Yep,
Thank you.
exactly. You're welcome. So home style renovation, okay, this is the conventional answer to the FHA 203K. Okay, so everyone looked at FHA 203K, they got jealous, right, and they wanted to make their own program. So this was Fannie Mae, Freddie Mac's conventional answer to the FHA 203K. So the guidelines are very similar, but with some extra things that are not allowed under the FHA program, because FHA is a government program. This is a private sector Fannie Mae program. It does allow for as little as 3% down on owner-occupied, 10% down if you're doing a secondary home or a vacation home, and 15% down as a down payment of an investor. Now, what is the difference between a second home and an investment loan? Suzanne, you want to answer that?
A second home is really intended for it to be, say, a vacation home. So if you live someplace on the mainland and you want to buy a home here on Oahu, that would be considered a second home. An investment home really means you never intend to live in it yourself personally. You are going to rent it out and derive income from that property.
Excellent, thank you. And because it's a second home that you're not going to be renting out and using as a vacation home, we cannot use any income from a second home transaction in order to help you qualify. However, if it is an investment property, we can use 75% of the projected income from that property in order to help you qualify. And the way that we do that is when we order your appraisal, we also order a rent schedule. Tell us how you come up with the rent, Ron.
Rent schedules are similar to an appraisal. You're looking for comparables, properties that are currently rented, and then we make adjustments for the differences in living area or bedroom count or whatever. But you're trying to get the most similar properties that are currently rented.
And he may even perform very magical calculations and in-depth research, like looking in Craigslist or the newspaper, right? For properties that are being offered at a certain rent so that they can assign what they believe that rent may be or what that property may collect in the form of rent month after month. Now, one of the things that we have here is that the renovation loan allows for 15% down payment as an investor. What happens if you have 15% down as opposed to 20% down? Can anybody tell me?
Lower rate.
Lower rate if you put down a little bit more, but moreover, lower payment because of mortgage insurance. Remember, if you have less than 20% down, there is a component to your payment called mortgage insurance. Does anybody know what mortgage insurance is?
The private mortgage insurance.
Yes, private mortgage insurance. Go ahead, Suzanne.
There's this, whenever, like Judy was saying, less than 20% down, you're gonna have monthly mortgage insurance, because it's a risk to the lender, because you're not putting as much money down. On an FHA loan, it is for the lifetime of the loan. You would have to refinance or sell the home to get rid of that monthly expensive mortgage insurance. On a home style renovation, which we put under the conventional loan product, it's not a government product. Once you reach that magical number of, say, 79% loan to value, you can request for the lender to remove that monthly mortgage insurance without refinancing your home and incurring extra closing costs. So it's a wonderful way to go.
Yep, absolutely. So if you have the minimum down, which is the 15%, you can still go with it. But if you want to keep your payment down, 20% is that magical number for investors, which is why we always hear about 20% when we're out there. So conventional loan limits right now, $1,073,000. What does that mean? That means that the average home here in Honolulu County is well over $1 million. For realtors in this room, for November, what was the last count of what the median home price was for single family residences? Huh?
$1,049,000.
$1,049,000, right about $1,050,000. Okay, it's been hovering right about that number. When we do home style renovations, we've got 12 months to complete that renovation. All right, VA renovations. So what most people don't know is you can even use a renovation loan with a Veterans Administration loan. And what that means is that beautiful zero down payment component that you get for your veterans. You can use that and still get up to $50,000 back in order to perform your cosmetic upgrades. So once again, not for major renovations when we're talking about a renovation loan for the VA. And the reason for that is because how long is a tour for a veteran in their tour for the most part?
3 years.
3 to 4 years, depending upon their branch, right? So if it takes 2 years to get your permits, where are they going to live, right? So that is why when we're dealing with the VA loan, that is the only one that does not have a limited and a major version, because the reality of it is that they want the veteran to be able to move in right away. Move in, customize, get your cabinets, get your flooring, update your bathroom, but you need to be able to be living in that home right away because you've only got 3 or 4 years, right? So the VA home loan, they can customize up to $50,000 with cosmetic or solar and still have that zero down payment capability. Honolulu County for VA loans, $970, $800, and because you're just doing some cabinets, some flooring, some painting, a little bit of solar, we've got 4 months to complete on this renovation loan.